you can get better returns if you are investing your money for the longer term. Things that have immediate liquidity with no redemption fees and are not asking you to invest for a couple of years at least, those are going to tend to return lower returns to you. And you really have to understand liquidity. Like, what are the catches? So if someone says to you there's immediate liquidity, they may limit that on a quarterly basis, or they may be at a gate that, meaning they may be at a stop that and not let you out of the fund. So those are really important questions for you to ask. And so it really comes down to, what is your own strategy and being able to feel comfortable with the sponsor, because even if they have a conservative focus, are they fully deploying the capital that they're raising? Because if they aren't and they're sitting on a lot of cash, then they're not being able to generate with your cash potentially enough return to return to you the promised returns that they've made to you. And then your capital may also be at risk if they're not generating the returns that they expect to internally in order to pay you what you expect to be paid in your monthly payments, if the company makes monthly payments, and your principal back at the end.
If you're a real estate investor and are wondering how to raise and leverage private money to make more profit on every deal, then you're in the right place. On Raising Private Money, we'll speak with new and seasoned investors to dissect their deals and extract the best tips and strategies to help you get the money, because the money comes first. Now here's your host, Jay Conner.
What if raising private money was not at all about pitching? What if it was totally about trust, positioning, and playing a long game most investors never see? Because here's the truth. Capital doesn't chase deals. What does capital do? Capital chases confidence, clarity, and credibility. Welcome back to Raising Private Money. I'm your host, Jay Conner. Now, today's guest is someone who has spent over 2 decades operating at the highest levels of capital, relationships, and investor trust. Her name is Mariah Harkins. I'm so excited to have her on. Now, Mariah is a senior sales executive who leads investor relationships and capital distribution at the company titled Lukrom. It's a Phoenix-based real estate investment firm specializing in private lending and private debt funds. She works directly with broker-dealers, RIAs, family offices, high net worth investors, helping deploy capital into private lending, real estate, and development opportunities. Now, in this episode right here, we're going to be breaking down how sophisticated investors think, what actually builds long-term capital relationships, and why most real estate investors get private money wrong. Now, if you want to stop chasing money and start attracting it, this conversation, I promise you, is for you. You're going to be meeting Mariah right after this. Mariah, I'm so excited to have you on the show. Welcome to Raising Private Money.
Thank you, Jay, and Happy New Year.
Happy New Year to you as well. Now, Mariah, you've been raising and allocating capital for over 2 decades. I got that right?
You did, yes.
Now, here's the question. With all that experience and with markets changing all the time, what would you say are the biggest shifts that you've seen in how capital is raised today, perhaps compared to earlier in your career, and what most investors haven't adapted to yet?
Well, I will say that when I first started raising money for a company in San Francisco, I think there just were not as many product choices as there are today. I think there's so many people today that have so many choices, and so it's hard for them to navigate. And there have been private investments that folks have gone into that have not performed as they thought they would, and some that have performed in a great way. But when there's so many choices, going through your due diligence and really finding a company that you can trust and diversifying into lots of different investments are really key to spreading your risk and being able to do private investments the right way.
What type of asset class are you and your company focusing on these days?
So we focus on real estate. So I think, for your audience, it seems as though there are a number of people that want to do investing in real estate themselves to rent out the properties. There are others that are passive investors that may not be ready to do it on their own or may never want to do it on their own, that are looking for opportunities with professional investment firms to be able to do that passively. So what we do and specialize in, mostly our core investment is a private credit fund. So we lend to individual businesses or bigger businesses that want to either acquire, improve, or develop real estate. And then we also do a couple of real estate development projects ourselves where we raise money for those investments as well.
Okay, so the focus is on real estate, which is what I have been in now for decades and decades. So when it comes to real estate, there's all kinds of subclasses. There's single family, there's multifamily, there's commercial, there is self-storage, there's land. Are you and Lucrom like all of that, or more focused on one particular area?
So we're really focused on the real estate investor that has a need for capital. And so if you have created a business for yourself where you are seeking to acquire real estate and you are either trying to improve it to sell it, or you want to keep that real estate longer term, we're mostly focused on residential because in the Phoenix area, there are a lot of homes and businesses that are in the business of improving homes to sell them. Our loans are 6 to 12 months, so we're not typically a long-term fit for many businesses that are seeking to acquire real estate, but we are used as a bridge loan sometimes. So if they want a 6 to 12 month loan, and then they want to go get permanent financing later on. But typically people will come to firms like Lukrom when they either have a short-term project where they're doing an improvement to sell the property, or they want to acquire a property quickly and the bank financing takes too long. So they come in and they may take a loan from us for 3 months, 6 months, 9 months until they can get permanent financing on a longer term project.
Sure. So would you classify Lucrom as a hard money lender to the end user?
Yes. Yeah, I would classify our company that way. My side of the business is to raise money for a fund that we've done. So if you take all of those loans collectively, we've got a fund. And so we've got a originations and lending side. So they're out there looking for people that have a need for capital. And so because they want to, acquire or improve real estate, they might want to acquire a piece of land, or they might want to acquire a bigger real estate project, but they want to get into that project quickly. And then later on, they may refinance it into bank financing. But my side of the business is to raise the capital so that our originations and lending side can build a fund around all of these loans in the portfolio.
Yeah. So to make sure our audience that's listening is understanding what we're talking about, here are the different moving parts. You have the part of the company, Lucrom, that's raising capital for their funds. And of course, this is where Mariah comes in. Yep. She's raising capital from family offices, individual investors, brokers that have capital to deploy. Mariah's getting that in the fund, and now it's in the fund. And then the other side of Lucrom is now they're going to be lending that out. They have the origination department, and then you have the other side of that company, real estate investors that want to borrow money on a short-term basis from Lucrom. So just so everybody knows what we're saying, Lucrom, that's spelled L-U-K-R-O-M, L-U-K-R-O-M, yep. Based out of Phoenix. And the website's very easy, www.lucrom, So let's talk about specifically what you do, Mariah. That's the raising of the money. When it comes to attracting high net worth investors, family offices, what exactly moves, as you said in the introductory comments, there's so many options out there. I mean, there's so many different options for people to invest in. What is it actually today that moves the needle for people to invest in your fund? Relationships, track record, structure, storytelling. What's your favorite ways to attract it and why?
Yeah. So, Jay, I started with the company a little over a year ago. They hired me because I specialize in long-term relationships I built with registered investment advisors and broker dealers, some family offices over 20 years. And so prior to me joining, Lucrom was raising their money through friends and family, referrals from friends and family, some high net worth investors that heard about Lucrom. We did a lot of social media marketing where we were targeting Facebook and Instagram. We did not find that successful. That was done prior to me joining the company. And so, I think when you have a fund like ours, our rates that we pay investors are between 8 and 9%, depending on how much is invested in the fund. When you're out there trying to market through Facebook and Instagram, I don't really think that's a good channel for a professional fund where you are trying to provide education and you're building relationships, because it really does come down to so much out there. They might get ads from 100 different companies trying to raise money. And so how do you sort through that? And how do you build a relationship and build trust? And so when I came in last January, they brought me in because we had pretty much exhausted our friends and family and referrals from friends and family. And we still have people that add to their investments, still refer people in. But you can go out there when you're first starting, which we did a couple of years ago in this fund, and you can gather your friends and family around. And of course, they're going to invest in you because they know you and they trust you. And so when you're raising money from high net worth investors, building that level of trust with the end investor is critical. We're a really good option for people that want to get into the real estate business in some ways, but they don't want to do it themselves. So they want a passive investment and they want diversification, where we've got loans on, lots of diversified types of properties. We're in a first lien position so that if the borrower is not paying back their loans, we have the ability to take that property back, which is very protective of the investors. But what they brought me in to do to expand how we were raising money, knowing that we kind of exhausted the heavy inflows of friends and family in the beginning of the fund, is for me to go out and build strong relationships with broker dealers and registered investment advisors who have registered representatives under broker dealers and advisors under these RIAs, who what they do for a living is they advise their investors and their clients on all of the options that are out there. Most of them are looking to diversify into lots of different asset classes. They're really understanding the investor's risk profile, what their goals are. So they're really getting to know the end investor. And what I'm doing with my team is we're educating the firms so that they will agree to allow us to educate the advisors underneath them. And then once we're educating the advisors who have the clients that may be suitable for this type of investment, we really need to get across to them through education and due diligence that they conduct. We've got a due diligence data room where they can go in and look at all of the information that's out there. And we're not typically trying to replace investments that they're already offering to their investors. We're trying to complement it. So in our fund, where someone can go into our fund and receive an 8 to 9% cash flow that's paid to them monthly, we are structured to protect the original investment for the investor. And we take several, our focus is conservative. So we're doing short-term loans. We're in high growth markets, which tend to be more resilient when there's market downturns. Short-term loans, you don't tend to have a lot of problems when you have a 6 to 12-month loan, when you are first in line as the lender to step in and take the property if the borrower can't pay on the terms that they've agreed to. And so you typically don't have problems with short-term loans when you're in a first lien position in a high growth market. So that is the niche that we have decided to focus on at Lucrom. But when I'm out there working with a financial advisor that might have 100 of people like me with funds that range from risk and reward. So some are low risk, some are high risk with higher returns, but you're taking a lot more risk. What I'm trying to do is to position myself where I'm educating, providing due diligence resources. They build trust with our company. They get to know us. They understand the structure of our program, and they decide which investors within their universe of investors are suitable. And so I'm not typically going in to try to replace anything they're already doing. I'm trying to complement, to be part of the fixed income side of an investor's portfolio that is really more on the conservative side of private credit. So they might be offering other private credit funds that, private credit can range from a very high level of risk. You could be lending to private companies. You could be lending on real estate. You could be in first in line if something goes wrong with the loan. You could be fourth in line if something goes wrong with the loan. So I would just suggest, if you are trying to do this yourself as a high net worth investor looking for funds, really get to know the sponsor, really find out whether or not you can trust that sponsor, look at their track record, determine whether you feel like there's integrity there, and then really look at your overall investment strategy to see if this could be a fit within your current portfolio based on your own risk tolerance and your goals. Or if you have a financial advisor, they will be able to present you with lots of different solutions that provide that diversification for you.
That is fantastic advice, Mariah. No matter what people invest in, there's risk. As you mentioned, there's low risk, medium risk, high risk. And everybody's got their own definitions of that. What is low risk? What is medium risk? What is high risk? For your investors that are investing in your fund, which is a great way to be in real estate and totally passive and let the sponsor and operator, take care of the day-to-day operations, what would you identify are the risks for your investors as they invest? One way you've certainly mitigated it is they're not investing in a fund that comes with no security. Right. It sounds like they're getting a mortgage or a deed of trust and giving them the same security that the local bank or mortgage company would get. But what would you identify as the realistic risk, as everything has risk?
Yeah, absolutely. It really comes down to what is the experience of the sponsor? What have they done before? If the sponsor fails because they're not making good decisions, then there's risk. So you're putting your money into something. Our particular fund, there is immediate liquidity, but we have redemption fees for the first 3 years. So you're committing to our fund unless you have a hardship, where we will let you out without a fee. You are going into this with the intention of investing at least 3 years. So that's an important aspect to really understand, is you can get better returns if you are investing your money for the longer term. Things that have immediate liquidity with no redemption fees and are not asking you to invest for a couple of years at least, those are going to tend to return lower returns to you. And you really have to understand liquidity, like what are the catches? So if someone says to you there's immediate liquidity, they may limit that on a quarterly basis. or they may be at a gate that, meaning they may be at a stop that and not let you out of the fund. So those are really important questions for you to ask. And so it really comes down to, what is your own strategy and being able to feel comfortable with the sponsor, because even if they have a conservative focus, are they fully deploying the capital that they're raising? Because if they aren't and they're sitting on a lot of cash, then they're not being able to generate with your cash potentially enough return to return to you the promised returns that they've made to you. And then your capital may also be at risk if they're not generating the returns that they expect to internally in order to pay you what you expect to be paid in your monthly payments, if the company makes monthly payments, and your principal back at the end. So with our company, when we raise money, we're making sure that we're raising money that we're able to invest right away. So our company being mostly in the Phoenix market, it is a really robust lending market. And so we are restricted in how many loans that we can give out to the marketplace because we have diversification standards. So there's some loans we'll turn away just because we've got too much of an asset class in a particular area. But we have more demand than we've got money. So I'm raising money and the team wants more and more money because they have a lot of demand, and we've got to turn away loans in some cases because of the fact that our demand is so high that the more money I raise, we're able to place that. But if at some point it became more difficult for us to lend, they'd say, Mariah, we need to slow down the fundraising, because if you slow down the fundraising and know that you can place that money and you've got a full investment, we know that we can generate between an 11 and 12% return, which allows us to pay all of our overhead, all of our salespeople, the people that bring money to us, and pay our investors between 8 and 9%. So we're able to do that because we're fully deployed. So it's critical that you look at what's the integrity of the sponsor, what's the track record, what have they done, and is it realistic what they're offering you? Can they generate enough inside their company to keep your principal protected while they're paying you what they've told you they're going to pay you, without the returns being impacted and the risk of the sponsor going out of business or not being able to deliver what they promised to you when you invested your money with them?
Let's talk for a moment about the geographics of the people that you do business with. So, two-part question. Let's talk about people that are investing in the Lucrom fund as a passive investor. By the way, by you all paying out monthly payments, very out of the ordinary in my experience. So that's a big plus right there. So you got those investors that are investing in your fund, and then you have real estate investors that are wanting to borrow the money.
Yes.
So the people that are investing in your fund, are you able to accept people to invest in your fund from anywhere in the nation, or where can investors come from?
We are. The restriction in our fund is the investor needs to be accredited. And so that means that they, for the last 2 years, have had a $200,000 income, or if they have a partner, they're married or they've got a partner and the combined income is $300,000 for the last 2 years, they can qualify to invest in the fund. Or if they have $1 million net worth without including the equity in their home. And so investors like that tend to have more money to be able to diversify into a lot of different investments, which can spread their risk. But we can take investments from anywhere in the country. So if someone came directly to us or had a financial advisor that decided this was a suitable investment, we can take those investments. We specialize in the Phoenix area. We're here. We've got a deep level of experience in the Phoenix area, and it is a market that's attracting global companies. And so as the economy in Phoenix continues to grow, there is a strong need for continued development of multifamily. There is a lot of improvement projects being done in all different kinds of real estate, but we see it a lot in single family, and we see it a lot in multifamily, trying to keep up with the demand of bringing workers into a growing economy in Phoenix. We choose to specialize in Phoenix because we're here, and it makes it easy. We can visit our properties that we've lent money on and keep a really close eye on it. But we are in other high growth metro markets that are like Phoenix, and we're expanding into that. As time goes on over the next couple of years, you'll see us in other high growth markets. So if the investor, you can be anywhere in the country. So let's just say you are a real estate investor and you want to do this yourself, and you've done a couple of improvement projects. So we are not a good lender for you to come to if you want to do an improvement on your own home, because we only lend to businesses, and you have to have several projects that you've done and completed for us to be comfortable with going through due diligence to be able to lend money to you. And it's only going to be on a real estate project that you want to improve or acquire or develop. It's going to be a 6 to 12 month loan. So we're really good in regard to somebody that needs short-term money. There are lots of other lenders out there that certainly will take a second or a third or a fourth position in a property. We keep our loan to values about 60%. So if you come to us and you need a loan for $1 million property, it's likely we're going to give you about a $600,000 loan. And we're going to ask to be in a first position so that if you don't meet your obligations back to us, we've got the security of the property that we lent the money on. So, for folks that are in higher growth metro markets looking to, do this to expand their portfolios in real estate, we're a really good partner on that part too, to be able to partner with you. We can act pretty quickly within a couple of weeks to be able to get people money, which is why people would come to a company like ours versus a bank initially, because they need to be able to act more quickly.
You mentioned that, every day you work with registered investor agents, you work with independent broker dealers that have clients, and those clients are looking to place their capital to get a nice rate of return that's, safe and secure. You sort of mentioned this, but I want to dive a little bit deeper in it. How would you say you tailor your messaging to these brokers, to these registered investor agents differently for each of those, as opposed to other sponsors that may be treating everybody the same?
Yeah. So my strategy, relationships are critical. I mean, trust is so important. They brought me on because I've built relationships with registered investment advisors and broker dealers over the last 20 years. So there are firms that will go through due diligence and make quicker decisions because they trust me. And they know that I'm not going to work for a firm and put my reputation on the line unless I truly believe in it. One unique aspect of Lucrom is that we have what's called a first loss commitment. And I'm invested in our fund, as well as our executive team, our advisory board, and other employees, where we have close to 5 million. It might actually be even a little bit more than 5 million right now. But we take the first loss. So we are in a class of our investment that if our firm and our fund was not generating enough to pay the 8 to 9% to the clients, or you reached, the third year, or you had a hardship situation before that, and you wanted your money back, your original investment, your full original investment, we are going to dip into that $5 million if there's ever a situation where that monthly return dips, or your capital account, what you originally invested with us, dips. So that full $5 million would have to be exhausted before you would ever feel a loss in our fund. So that makes it easier, because I actually in 20 years have never worked for a company that put their money on the line that way. So me being invested and putting myself in a subordinate position helps to establish trust, because you're not going to do that if you thought the fund was going to lose money. Like, you just wouldn't put $5 million of capital on the line that stands in a subordinate position to protect investors if you weren't really confident. So those are the kind of things that, it comes down to trusting the person that you're offering the investment to. And then, Jay, the other part of it is they have investments that they probably have been offering clients for a really long time. I'm not trying to replace that. I'm not trying to say use Lukrom's iFund instead of ABC's private credit fund. I'm trying to get them to put us alongside the investments that they really like, that they've vetted, that they feel comfortable with, as an additional diversification tool on the fixed income side of an investor's portfolio. So me educating a financial advisor who have, most have been in the business for a really long time. They can talk the lingo, you can explain things to them, where if you're talking with a high net worth investor, you educate in a little bit of a different way. You don't use the industry lingo. You make sure that they understand all of the different aspects of the fund so that they fully understand what they're getting into. And if you're looking for a company or an investment that you've found through a magazine or a newspaper or a Facebook ad, get to know that company, really ask all the questions. And if they don't take the time to spend a lot of time educating you on the risks, as well as what to expect from the company and how they're going to protect your investment, and their track record, and you, if they're just trying to push you into the investment without taking the time to educate you, that's a red flag. So relationships are really important. Building trust is critical.
Excellent advice, Mariah. As we wrap up, Mariah, what would you invite my audience to do?
Well, so if you're invested in learning more about our investment fund, we would love the opportunity to educate you. You can reach me directly. My email address is mariah@lucrom.com. So it's MERRIAH at Lucrom. So it's LUKROM.com. You can also just go to our website. You can reach me through the website as well. Or if you're interested in seeking a loan from us because you are in the business of acquiring real estate to improve or develop, you can reach out to me and I can put you in touch with our group that provides loans out to people that want to do this themselves. So we're a good option for folks that want to get into a fixed income investment with a diversified portfolio of real estate behind it. But we're also a great choice for people that are seeking to receive capital where they can have a fast turnaround to be able to do the projects.
Mariah, thank you so much for joining me here on the show. All right. That's a wrap up on today's conversation with Mariah Harkins. If you are serious about raising private money, here's the takeaway. Capital does not respond to hype. It responds to clarity, credibility, trust, confidence, and consistency. And Mariah here on the show just showed you how sophisticated investors actually think, how they decide and deploy capital. If this episode helped you see capital raising differently, I need you to do me a favor. Subscribe to Raising Private Money. Leave a review, like, share. If you're watching on YouTube, click that bell. And share this episode. You're one conversation away from making an impact. Share this episode with another real estate investor who's still chasing deals instead of attracting capital. And if you want to learn how to raise private money with confidence without pitching or begging or relying on the traditional methods, you can head on over to my website, jayconner, JAYCONNER.com/book, and I'll mail you my book, Where to Get the Money Now, absolutely free. I'm Jay Conner, and remember, when you master the relationship, the money follows. I'll see you right here on the next episode of Raising Private Money.
Are you feeling inspired by the knowledge you gained in this episode? Then head over to jayconner.com/money guide That's JCONNER.com/money guide and download your free guide that shares 7 reasons why private money will skyrocket your real estate investing business right now. Again, that's jconnor.com/money guide to get your free guide. We'll see you next time on Raising Private Money with Jay Connor.